Boom, boom, boom!
Pam, 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 pam!
My dear friends, I will be talking with Martin about what is really happening behind the curtain or beyond the curtain in this great world of blockchain. And what does per second billing actually have to do with blockchain and cryptocurrencies? And whether we'll get anything out of it, that is our topic. Martin, what year were you born anyway?
The date is September 1st, 1991.
All right, well, do you remember when mobile phones were first introduced in Poland?
Yes, I still remember when there was per minute billing and people would call with a stopwatch in their hand.
There were so-called 5-second billing increments. You're talking about per minute billing, meaning every additional minute significantly increased the cost of the call. I remember I had my first prepaid phone. It was with Idea, and that minute cost 1.75 zlotys. That's why there was that stopwatch you mentioned, but there were also 5-second increments. I mean, back then there was this thing where...
That was later.
That was later. I think it was right at the very beginning, and then they abandoned it.
Okay, maybe.
That for the first 5 seconds, as you said, but if you disconnected before the 5th second, there was no charge.
Aha.
So in general,
So that
to save money, people just, talked almost like they were using Morse code, keeping it extremely brief, and then they hung up.
milk, coffee, yes.
Exactly things like that. It was really like that. And if you had to rush someone, you'd call, say, we're waiting, and hang up. I remember a story like that. I look back on it with a certain kind of nostalgia. Those were the days, but I mentioned that per second billing because today I want to talk to you about a topic you've prepared very well for and inspired me to have this conversation. I want to talk to you about blockchains used by big corporations. And here it turns out that I'm not saying I'm a speculator, but I'm speaking now on behalf of the entire community. We as speculators, as those who want to use the main tokens, some blockchains want to make money on it, we want to invest in them and so on. Not necessarily. Either we are aware of it or we can use these tokens. One of such blockchains, which you were telling me about even before the broadcast, is actually heading towards implementing per second billing.
That's right.
Exactly, Canton Network. Let's start perhaps with what kind of blockchain this is at all, what its application is.
Okay, so maybe I'll start with the company itself. It's Digital Asset Holding, which created the Canton Network. It was founded back in 2014. So quite a long time ago, and the blockchain was only created in 2024. So you have to admit that they were preparing for a very long time, considering the time frame. I employed about 165 people, and the blockchain was created, as we hear, 2 years ago, but it processes, and here maybe I'll start with this, huge amounts of money, because daily, and this is not, I really checked this number many times, $360 billion of daily asset turnover on this blockchain. What is very important, these assets are not on the blockchain all the time. They are only there for a moment.
Exactly. Explain what it's about and what assets we are talking about. Well, because when I think about big corporate blockchains, then actually, especially those that are used in the world of funds, banks, etc., I have one association. Ripple. No, I'll ask you about Ripple too.
Yes.
Finally, for you to explain what this is all about. And I was wondering, is it actually true that the Ripple network was originally created before the year 2009? Could you clarify that for me?
Here? I don't know if we'll go that deep.
But to be more precise, could you explain exactly which specific parties the Canton Network is actually used for when it comes to settlements?
By financial institutions themselves. For example, one of the largest validators of the Canton Network is Visa, which also moves its stablecoin tokens there, and most cards. Visa, which is issued, also moves these stablecoins already today in bank settlements, meaning they are taken, converted to Canton. This stablecoin is sent to a specific institution that collects this payment. The Canton Network itself has its own speculative token, well, as we already mentioned, Canto, which we can buy, but in fact, do we as holders of this token really gain anything? That is quite an important question. But you asked about this per second accrual and how it happens in the market. So these are mainly transactions, repo, so we can think that these are mainly transactions.
I will explain right away what a repo transaction is.
We can assume in a very simplified way that these are transactions outside of working hours. So if we want to exchange some stock or bond between ourselves and the stock exchange is closed because it's Sunday or it's after 6 p.m. or we are sending it to China or Beijing or Europe during their working hours, well, we can't settle using traditional methods. So we settle using, for example, blockchain methods. So this is where the market token comes in, and very often these settlements are hourly, minute-based, every few minutes or by the minute.
In this thread, or at this stage where institutions settle outside of working hours, I imagine there are two banks that want to lend each other money. Besides, when we talked about an indicator like WIBOR, which causes great controversy in Poland today, well, that was exactly the indicator that talked about for what money, at what interest rate banks are willing to lend money to each other, how these transactions were allegedly taking place, which is also a subject of controversy because there were very few of these transactions. Well, the banks were supposed to transfer these funds somehow, and I imagine that these were exactly the funds they were transferring to each other. Well, I don't know if it was outside of working hours, but it wasn't just a regular transaction where one bank transfers money to another. And now you're talking about the fact that financial institutions settle up outside of working hours. Is this about that kind of settlement, as I mentioned, for example, in the context of WIBOR? Or is it, for example, about a bank due to the fact that there were a lot of, let's call them retail transactions, having to transfer a huge amount of deposits, like one big deposit to another bank or another fund? And if you could also say what is actually being transferred. Are these dollars, meaning stable coins, in other words, or are these some bonds? Or did you mention stocks, for example?
The answer is somewhat that it's everything. Well, unfortunately, that's how it looks, because let's start from our retail perspective. Are there institutions like eToro or Robinhood where you can buy a stock outside of trading hours? And that's why this transaction has to take place somewhere. And de facto, it will only appear on the stock exchange in the morning when the market opens. That price, that transaction, that impact on the price. But we can already execute this transaction because we want to take the money, not set an order that you can close at any time. So these are, for example, those transactions. This is, of course, a very big simplification for us as people, but banks exchange and also make huge transactions from currency exchange. Only we will get to that because they are reluctant to exchange currencies. They prefer to exchange bonds. It's about granting loans, collateral, or all kinds of bank settlements. For example, a bank wants to offload the risk of Japanese government bonds and wants to take on more Chinese ones. And one day, because it came out of their balance sheet and it turned out that day that they have too much and they need to reduce it, so they do it. And this comes up for them after working hours, so they exchange it among themselves then, and these are those transactions. Repo and many others, because there really isn't a single clear-cut answer. Because at the beginning I wanted to explain it from a very primitive perspective of us as retail users, what might affect them. But in reality, most of these transactions are large transactions that don't concern retail ones. And why do they prefer to settle in treasury bonds, for example, or even corporate ones, but treasury bonds are a great example. First of all, for treasury bonds, banks do not need to have any security deposit. For example, if we have corporate bonds, then we have to have more or less a few percent of that currency as a deposit. So if we have 100 million, we have to have $3 million on top of that 100 million. So that, because these are still client funds, right? These are not our funds. Let's remember that too.
Yes, I mean, you're talking about fractional reserve here because...
Yes, in a way, yes.
So the fact that if I, as a bank, lend to clients, so as you said, 100 million, well, I have to hold it. I can't spend that money at all because I had to get that 100 million from someone beforehand.
Yes, but you're talking about, for example, cash loans, mortgages. Well, but banks also use your money to buy corporate bonds. With your money, they also buy government bonds. And government bonds are such a grateful topic for them because they don't have to have any reserve for it, because it is considered that it is, as it were, money. And I want to explain this so that it is clear
that if a bank decides to invest, for example, in stocks and allocates 100 million to stocks, it turns out that they can have those 100 million in stocks. But for every 100 million in stocks, they must have a certain amount of dollars. Such a rigid security that they cannot touch anymore.
Because it is, as it were, a hedge against that risk, meaning exchange rate risk, whereas with government bonds, they don't have to have it.
And with cryptocurrencies, yes, I'll ask out of curiosity because I know they check that. If a bank spends, for example, invests 100 million in cryptocurrencies, how much must it have in parallel in an untouchable deposit account?
Right, well, that is exactly how it is calculated. It actually comes from the Basel III framework, which is that specific set of international banking regulations that originated from Basel. And there are these risk weights.
Yes.
For government bonds, it is 0%. The risk weight for mortgage loans, that is 35%. Now, I'll tell you how it's calculated as well. For corporate ones, it's 100%, and for crypto assets, they are in the lowest class, which is 1,250%. And it's simply calculated 1,250 times 8%. Where does the 8% come from? It's just been accepted. Everything times 8%. So for a mortgage loan, de facto, for 100 million, you have to hold 2.8 because that's where it is. 30% times 8%. I understand.
Okay. Yes, yes.
I understand. For a corporate loan, 100% times 8%, which is 8 million, right? Out of 100 million. Well, and for crypto assets, 1,250 times 8%, which is 100%. So holding any asset, any crypto asset, we must have 100% of its equivalent in collateral.
Exactly. And now the question is also, is it calculated based on the purchase price?
Value. We have to rebalance the value all the time. So it is very risky for them. That's why institutions like JP Morgan prefer ETFs, because de facto they kind of bypass the law since they don't hold the crypto asset then.
Yes, they just hold some financial instrument,
which is valued as an ETF, which is backed by collateral. The risk level is rated at 40 because it sits higher than standard corporate bonds but remains lower than typical stocks because it's unleveraged, etc.
And this is where we start to understand financial engineering at all. The concept of financial engineering is also an interesting topic for me because I always associated an engineer with someone who builds bridges or writes code or something. And now we see that an engineer is someone who must have a great flexible mind to build the most interesting financial solutions. And what you just said is very important. If a bank or some financial institution decides to buy treasury bonds, I have 100 million, I bought treasury bonds for that 100 million, and I don't have to do anything.
I don't have to secure it any further, because let's remember that those 100 million that the bank used is not its own money.
Of course, a bank doesn't have its own money.
It has a little, but in fact, most of the transactions it makes are not its own money. So in this case, it must have 0%. Well, okay, so what is this all about, this whole Canton and second-by-second settlement? Well, because back in the day with repo,
with
interbank or inter-institutional settlements, because it's not just banks involved, banks definitely prefer to settle with bonds rather than stablecoins or cash because they can. De facto, they also take place on this Canton, stablecoin transactions, but why don't they want to? Because they simply get nothing out of it. It's just a transaction cost they have to bear, and they don't get any benefit from it. But if they have a treasury bond, a corporate bond, or even stocks now, because that's the idea behind it, it is settled. The thing is, even if a stock pays out once a month, pays a dividend, because in America it's more common for them to pay out once a month, or bonds that settle daily, they calculate by the minute who held how much of that bond, and they are then able to distribute that reward dividend or bond interest. So let's put this into plain, simple language. I give you this bond, you hold it for 15 minutes, you give it to the viewers, and the viewers give it back to me after an hour. And then we settle up based on the fact that you held it for 15 minutes out of those 24 hours. The viewers held it for an hour, and I held it for the rest of the day. And we distribute the reward proportionally based on that holding time. And that is possible thanks to the blockchain.
Exactly. Because with those classic financial solutions or technological limitations that were in place until blockchain appeared,
We could only do this while the stock exchange was open, de facto.
And just as the IT system allowed, and now if it's worth stepping back in general to show the other extreme, something we've talked about many times on our various broadcasts, the financial oscillator from the
90s, yes, very famous.
Yes, in Poland. The Artby scandal. Banks would pass on the information that a customer had withdrawn a deposit, but this process was quite slow, often involving a several-day delay or sometimes even a full week-long wait before the transaction was fully processed.
Because back then, everything was still recorded on
paper. There were IT systems there, but they dated back to Noah's time, so, well, they didn't work that well. How did it work? It worked on the principle that they would go to one bank and deposit, let's say, 100 million, and the bank would confirm on paper that they had deposited those 100 million, and then interest would start accruing in that bank. These were the 90s. Balcerovich's reforms, and so on. There were very high interest rates, I think even up to several dozen %, right? So quite a decent amount of money was being made from that. And with that confirmation, they would go to a second bank on the same day and deposit that confirmation in the second bank. And back then, the regulations stated that the second bank would contact the first one to collect the money, which usually took a few days, even a week, but it would start accruing interest
from the day of accepting
that slip of paper. And no one assumed that someone might frequently perform such operations. So they didn't take care to check exactly when the funds left one bank for another and how they actually deposited real cash in one bank on the same day, and on that same day deposited that slip of paper in another bank. They were effectively getting double interest.
Yes, from the same money.
From the same money.
Or sometimes triple or quadruple.
Exactly, because they skipped the second bank. From there, they took the paper and went to the third one. And and it was simply called a financial oscillator. From one cash register, they had a lot of interest. Interestingly, they themselves claim that they didn't want to make money on this. It's hard to know who to believe or not, because their main business wasn't based on that. Their main business was based on the fact that they received a loan, kopieki in South Korea. Back then, the company, which was called something a bit different, I don't think I remember what it was called, but today's LG, thanks, actually told them that they could sell VHS players, TVs, etc. In Poland, and they only had to pay when someone in Poland bought it from them. A very strange situation. I've also heard many different stories about how it turned out, but someone gave them a massive trade credit. And they lived off that, but they claimed they had to have access to cash in every city in Poland. And that's why they created this operation, so that their employees, people, and so on could go to any bank and be sure that they would have cash for some other operations. Well, in any case, we see there that the IT system led to the fact that as if one deposit was earning interest multiple times, because there was no automatic transfer, no immediate transfer of this information. And here, in the case of these solutions we are talking about now, you are saying, Martin, that it is possible that even if I hold a treasury bond for 15 minutes as an intermediary bank, I can derive benefits from it, that I am entitled to interest precisely because I held them for those 15 minutes.
Yes. I didn't find exact information on what the smallest settlement unit is, because I was curious about that, whether it could even be per second billing, right? But I didn't find it. I only found in Canton, in their white paper, that they will be able to settle it down to the like every minute, like it was written in minutes, but
that's exactly why I was asking about the per second billing from the 90s in mobile telephony for those who haven't quite grasped this connection yet. Well, it's an amazing thing. And that's exactly why you pointed out that banks don't want to settle in stablecoins.
Well, why would they? Well,
they simply don't have...
You don't have any benefit from having held it. Think about it today. How do you do it? International transfers, in fact, are often outside Europe because we're talking about once we leave the SWIFT zone, it very often goes through several banks.
Right.
Well, it's definitely simpler to settle in bonds.
That is exactly right. Banks settle in bonds, and now it wouldn't be possible at all.
Not to mention that the transaction cost is lower, right? Meaning the whole exchange, because back then we had to pay on the stock exchange.
And
today we don't have to because we exchange tokens. Only the FII is aggregate at the very end of those final settlements and not for all those in between.
What I wanted to... Yes, you're talking about the fact that there are no intermediaries. Yes? So what I also wanted to say is that this wouldn't be possible at all, this discussion about all of this, if not for this great phenomenon or occurrence, which we call tokenization. This means that we are trying to record everything in the form of information, specifically on the blockchain. That is the idea of tokenization.
I just have the impression that we look at it very romantically because we as blockchain enthusiasts, at least I used to, when I thought about RWA tokenization, imagining that...
Break down the acronym.
RWA, which stands for real world assets. Essentially, this refers to tangible or financial assets that originate from the traditional old economy world. We can think of this in broad terms, covering everything from stocks and ETF units to bank account records and government bonds. It even extends to legal documentation like notarial deeds, which establish clear ownership. For instance, verifying exactly who holds the title to a specific house. That is RWA. And such a blockchain enthusiast's dream, or such a wet...
Crypto enthusiast.
Crypto enthusiasts, yes.
Crypto fun.
Well, exactly.
That
is the difference. You're right. Cryptocurrency enthusiasts, there were two things. The first was that I would be able to have it in my own wallet.
Yes.
And that is a beautiful idea, which, like, when I see which way the world is heading, I think to myself, well, that will never happen. It will only happen for banks. And you will still, even if you hold it in your account, you will still have to connect to an entity to sell it. That account will have to be verified. You won't be able to send it to anyone else. And you will only be able to do it on exchanges with a license, etc. So it won't happen in that wet dream. And the second one, that wet dream of a crypto enthusiast, is that it will take place on our beloved blockchains, such as Ethereum or Solana or any other, Algorand or any other. Thanks. So what? That if I buy an Ethereum token, I will be the beneficiary of this.
Yes.
And here is, well, what we have right here.
I mean, that's not exactly happening in the way you described. Maybe it happened once, but I remember in 2000...
But why? I mean, Sławek, why would corporations pay even if it's super cheap on Ethereum and transactions cost 50 cents? I mean, that's peanuts to them.
Yeah, I'll come back to that point. I wanted to touch upon the very idea of tokenization, the one I dressed up in 2020. Actually, that's how we met back then. Yeah.
That's how we met.
Yes. And she was talking about the fact that I, on my phone, in my crypto wallet, would be able to hold the ownership rights to my apartment, for example. Or perhaps it is something that I have always really liked. And to be perfectly honest, I actually still firmly believe in this specific investment model today. The core idea is that whenever I decide to buy a share of some company, I am truly the one who is reaping all of the long-term benefits that come along with that ownership, solely and exclusively from the fact that this company generated a good result. And of course, that its value is growing.
Meaning that it will pay out a dividend, because we should also note that some companies...
Exactly, that's a topic I have a big problem with all the time, that companies that will never pay a dividend, of course, maybe they will pay one someday, but generally they don't pay dividends. Their value keeps growing all the time, and people buy those shares.
Honestly, what is the point of all this? And a great example here is Warren Buffett and his Berkshire Hathaway, which by design is never supposed to pay a dividend. Even Warren Buffett said it, it's simply unprofitable from an economic and tax perspective. I have to pay tax on it then, and you have to pay tax on it. Everything. The entire profit will be reinvested or kept in the account balance until a good proposal appears. Because we are talking about that order of magnitude. We buy a company, or we buy 1/3 of a company, or we take over the whole thing, because that's the order of magnitude of money we're talking about. And
that convinces me in the sense that I understand it, that it may be the case that the company will never pay a dividend. That is a very convincing argument. Why do I own shares in this company? Because I am counting on someone buying this company out, and then I will also be a beneficiary of that, right?
But as a retail investor, you might find it challenging to keep pace with the market. You will never take over the company, right?
Yes.
And in fact, you are just looking for someone who values this company higher, but isn't able to realize its value. Because that is exactly such a strange thing, isn't it? Well,
as a retail one, because he finds, yes, someone who wants one, who knows what of this company wants to buy it from me. But generally, what I'm getting at, and I'll explain in a moment why we even ended up here in our conversation, is that I started with the fact that when I buy a stock, I participate either in the profit of this company, counting on a dividend, and we know how it is with dividends, that the company's board can always pull some trick, higher costs might appear, and not at all this
dividend, the decision that you won't pay it out and will carry the profit over to the next year because you want to invest. There's also a problem here whether paying out dividends is always a good signal, because that's already a long...
When I was thinking about tokenization, I wasn't thinking, I'm talking about the year 2020 to 2021, back when we were talking about it a lot, that I didn't mean to tokenize stocks at all, because that's the side where the blockchain enthusiast's dream is realized, but not necessarily the cryptocurrency enthusiasts. Simply blockchain as a technology has
application.
Yes, it has more and more applications. However, I was thinking that you can tokenize things that until now couldn't be captured or quantified in terms of classical finance. Let's say we have a company that produces helicopters, cars, and tanks, and we say we are tokenizing the production of only the helicopters. There were various tokens saying that, for example, from every helicopter that gets sold, we distribute among the token holders.
The idea is beautiful, and you know that
it was supposed to be organized not around the company's results, but around specific products or services.
I agree, but at the same time, you know that I went down that road and organized it, and in the end, it led to a state where it was a bond. That was the saddest reality, the real state of things. And let me give you one more great example. There is this project, I won't mention the name, which raised a lot of money in Poland for ice cream. And the dividend was supposed to come from every ice cream sold. Well, and like, it works, it functions. But the problem for this company at some point became that, and for every new location open, they were also supposed to buy back tokens. The whole problem was that at some point, some locations were unprofitable. Well, because you open a location and it sells 50 ice creams, but...
I know, and tokenization. And
that becomes a noose for them then, right? Because it leads to the fact that if they want to maintain this deal with the token holders, then
they have to have the public promise they made that they cannot pay out, because
the company will go bankrupt.
Well, yes, of course. All right.
But okay, because we've strayed from the topic. Let's go back to Canton and his token, because maybe this is, because there is a token, we can buy it. And now the token didn't have an ICO. The token didn't have venture capital. It wasn't possible to buy it. There was no token pre-sale. The token is solely and exclusively issued by validators. So the mechanism is that by being a validator, you simply issue this token in a certain amount. And all transactions on the Canton Network, well, not all of them, but okay, transactions on the Canton Network operate on a burn mechanism. So the token you use to pay for this transaction with that Canton, you burn it. It doesn't go to the validator. The validator creates a new one. So it's a bit like in Ethereum. And there is also a bit of a problem here like in Ethereum, because the Canton Network has never become deflationary yet. Meaning more is being produced all the time.
Rather than
is being burned, despite those large transactions. And now, okay, but they process so many billions of dollars.
And
what happens, unfortunately, in the real world of finance? Well, those banks, those big institutions that do these repo transactions, they don't want to do them on a public blockchain. And they do them on the Canton Network, but on a separate private blockchain.
In a sort of side.
This is a blockchain which is de facto the exact same blockchain, but it is completely hidden from view and remains entirely private. Only the validators see it, and everyone sees their own transactions but doesn't see other transactions. Well, because that would be like banking advantages, and we're not even talking about cornering and such, you know.
Maybe we only notarize on that main blockchain, but notarization means we don't know the details. But if we do know the details, we can confirm that they actually looked like that, simply put.
But importantly, these repo transactions, meaning most of these transactions do not take place using these tokens. Because on this sidechain, there is a different token that is given to these institutions so that they do it.
Because
these institutions, all these institutions are simultaneously validated. And this leads to a situation where we buy this main token and think, great, they are doing so many transactions, we will be the beneficiaries of this. But in fact, we are not, because they are all validators and they create these tokens out of thin air, so to speak. I know that was the assumption, but there is no maximum supply of this token. And they, by being validators, keep receiving rewards, and they do it on a sidechain where we don't see those transactions. So on some hidden part of this blockchain.
That is also one of the significant overarching problems with Ethereum when it comes to its tokenomics. And honestly, the issue is even broader than just tokenomics alone, because Ethereum, back in the days when it frequently got congested, was still the most popular blockchain in existence, standing right alongside Bitcoin. Now, Bitcoin really has no primary use case other than simple financial settlements, whereas Ethereum was always supposed to be this big, gigantic, intergalactic computer that could handle everything. And as it turned out that Ethereum was getting congested, sidechains and various other solutions started to emerge. Second,
layers,
or perhaps
tokens are multi-chain in general, so then you move to a chain that is cheaper. And so what if you released an Ethereum token, meaning you created that base smart contract where you later transfer it?
And that's exactly the effect we have, that now a lot of operations are taking place on the second layer. I even decided on a third layer, which is funny in itself. And Ethereum is, as it were, a victim of all this.
Yes. Notice that Ethereum, there was this huge hype around Ethereum when they made it deflationary, meaning they implemented burning. If there is a sufficient number of transactions, there will be burning. The only problem is that burning will be greater than production only when transactions are very expensive, because the network will be so congested, meaning they will cost around $2.
And
nobody wants to pay $2.
So
we move to other networks, so Ethereum is inflationary again.
Also a very interesting discussion whether Ethereum still has a chance when it comes to the value of the token, the original one. Do we have to think about how much it was worth in the past? Do we have to say, no, those were times when it was in an unsettled state? Now we assume that the base value is the, I don't know, $1,500, and everything that is above that is for us a new.
But when is this base state still?
Well, that's a very good question. What I mean is that there will come a moment when we have to say, okay, there was an unsettled state. All sorts of things were just happening, but now the situation has stabilized, so the value of the Ethereum token should slowly rise. But our longings that we will quickly reach an ATH and break through that ATH and so on.
And why should it rise? Let's ask ourselves this construct. Because the token still has an infinite supply. It is being continuously produced all the time. And currently, 40% of the total token supply is completely frozen just to be staked. So in actual fact, there is really only a strong desire to profit from the staking rewards, which ultimately means that a large portion of the supply is sitting idle and remains entirely unused. You could say that if it weren't for this staking, 40% of the tokens would have no purpose.
Well, it's like it dilutes the value of the tokens that are in circulation.
Yeah.
Right? Generally speaking, when we look at all these various blockchains that feature a native token where the total supply is not strictly capped or limited, unlike what we see with Bitcoin where there is a hard cap, that creates a situation that is fundamentally problematic for long-term value retention. I have doubts here whether I would want to acquire such tokens, although I do acquire Ethereum.
But that
stems perhaps from some historical habits. Very interesting.
Maybe let's ask ourselves the question, because I tried to write it down for myself. What a network's native token must have in order to make economic sense. And I listed 3 points. The network must force the use of the token. It cannot be optional. That's like the first one.
It is currently burning.
For the price to rise, the token demand must exceed its new issuance, or alternatively, the overall market demand must be significantly greater than the current selling pressure.
Well, I think that's pretty obvious, isn't it?
Well, the core issue is that we are essentially forced into a binary choice. Either we introduce deflation, which implies that the system will become increasingly deflationary over time, Or alternatively, we introduce that specific demand, which inevitably means there must be significantly higher transaction costs compared to the rewards provided for stakers. It really comes down to that fundamental trade-off, doesn't it?
Yes, obviously. It's a simple game of supply and demand. Yes.
But I want to exclude speculators from this. What would have to function for the network to work without speculators if we suddenly assumed there were to be no speculators?
I understand that such mechanisms must exist. I think that for this third point, I would frame it, although this is a casuistic approach rather than a code-based one, I would frame it exactly this way. That demand that you need to pay more for network services in this token than the rewards that come out of staking.
Well,
and at the same time, it is important to consider that we are looking at this from a different angle.
At this moment in Ethereum, that is not happening.
Well, yes. That happened very rarely in general.
Well, only at times.
Sometimes.
And that's when everyone usually shouted that ETH is expensive.
And so...
that it makes no sense now, right? Because I have the impression that we are digressing and we still had an interesting
conversation.
I honestly think that we have completely exhausted this topic for now, so there is really nothing left for us to discuss. I can only mention a few projects, a few companies that operate here. I mentioned the repo market, and honestly, that is the most significant one. For example, a pilot project by DTCC and Euroclear, which are the central securities depositories of the USA and Europe. Along with BlackRock, JP Morgan, Vanguard, and NYSE, they received approval from the SEC for a 3-year pilot program on this blockchain to conduct these transactions. Full production launch should take place in October 2026, at which point there will be 50+ institutions in America. Euroclear also issued such an approval. Goldman Sachs has started moving, even though they had their own blockchain. They are starting to do more transactions now, more and more transactions on Canton. Similarly, JP Morgan also had its own blockchain, Onyx, and is also starting to move more and more over. And then there's Visa, which is moving. It's not huge money, 4.6 billion, of course, for Visa of stable coins. But most importantly, it is one of the main validators, one of the biggest ones. And the token itself made a nod to us because it is written in a different programming language. It is in a programming language, and
token or blockchain.
When we talk about the token and the underlying blockchain, it is important to understand that in this context, they are essentially synonymous. Now, it momentarily slipped my mind exactly where that documentation is located, but the key takeaway is that they specifically engineered an EVM-compatible solution to ensure seamless interoperability. But again, I want to be clear that this is really just a nod to us, the blockchain enthusiasts and developers, because, as I mentioned earlier, the vast majority of these actual transactions do not happen on the public chain anyway. Instead, they take place on private permission domains that are ultimately synchronized by Visa, which is quite fascinating when you think about the architecture.
I am fully aware that there are many more sophisticated networks in operation today that the industry actively utilizes. And unfortunately, it seems that not very much of that advanced knowledge or technology ever really trickles down to the rest of us in any meaningful way.
One is more well known, that is XRP, and a very controversial token. And another one is VeChain.
Next up is VeChain.
It's mainly used for logistics settlements. It has greatly streamlined many logistics solutions. Product tracking, it is used by DHL, by large corporations. VeChain as a token creates a derivative token. So by staking VeChain, you create the derivative token VTHO, which is gas. And the whole fundamental problem here is that no one from these large corporations actually buys VET. Instead, they all just buy this gas, and they certainly do not hold on to it for the long term. They really do not look at it as a serious investment at all. They simply buy it for one specific purpose, to pay for that transaction and nothing more.
But to buy it, you can only buy it with the native token. No.
That native token works just like it did back in the day with NEO and gas. Do you remember that?
So
by staking VET, you get the derivative token gas, with which you pay for all transactions. Even VT transactions. So they just buy it, and they also buy it at the same time. They buy and sell.
Okay, but I have to ask, is this really a token that is deflationary in nature? Well, I'm just trying to understand the mechanics behind it a bit better.
The problem is, it's not.
Again,
we come to the point that if they actually believed, well, again, we come to the point that they can't really, because we already talked about it, but the logic suggests that it would be better for them to buy the VET token, hold it, so it produces that gas for them to pay for those transactions, and yet they don't do it. Well, because I understand that financial institutions don't do it, but DHL or others, because this is logistics after all. Many companies could do it and almost no one does. It's less than 1% that decided to stake these VET tokens at all because they find it more, they simply view it as a payment gateway. They don't really care what's underneath. These are microtransactions and it costs less than cents. In the grand scheme of things, it cost 2 cents and it turned out cheaper for them than managing it in Excel across 13 companies, coordinating it and checking if anyone cheated. Simply put. All right. But there is also XRP. Exactly. This XRP is such a legend. I mentioned whether Ripple was created around 2009 or not as a symbol. Because the point is that Ripple as an organization, as a company, exactly, it is an organization that has existed longer than the token. Exactly, and in general, it is worth noting that XRP actually appeared quite a bit later as a digital token, but the company existed longer. That is exactly why I mentioned it earlier. Could you tell me what is it that they actually do? They, in fact, did what the Canton Network did in 2 years and achieved a network effect significantly greater than his. They simply wanted to settle the same thing between banks. Ripple focused heavily on international transfers. So it wanted to solve and speed up this process so that there wouldn't be these intermediary banks. And it was mainly about deposits here. So that's why nobody really cared that much about developing it, because nobody was deriving any benefits from it. None of the parties using the network. Yes. And here we come back to the fact that Ripple created the XRP token, which, as it were, we can already... but there are a lot of red flags there, like the fact that the owner of this token, the main boss, holds 30% of this token, and it's constantly being released and dumped on the market. These are huge dumps, but I won't go into exactly what those percentages are, because when I saw them, I was already terrified. That was an analysis from a long time ago, but I focused on how many banks use RippleNet, that's what it's called, meaning this Ripple solution. It actually turned out that it is not that few after all. We are talking about roughly 50 different banking and financial institutions. Now, while that might not seem like a huge result in the grand scheme of things, it is important to remember that these are very large established institutions. And interestingly enough, 60% of them still do not touch the XRP token at all. Again, this is happening on private blockchain. This is based on Ripple, specifically. Based on Ripple's solution, which is simply a copy of Ripple, only with privacy preserved, so that these transactions cannot be seen. Only the parties to the transaction can see these transactions and track them. Well, so that other outside people cannot see interbank transfers. And even regarding that 40% that is actually being used, none of those financial institutions hold the XRP token themselves. Instead, they purchase them on a buy, send, and burn basis, which means they are constantly acquiring and utilizing them in real time rather than holding them as assets. Because it doesn't pay off for them to hold it, because they prefer to hold, I already explained why. Because then they would have to keep the same reserve in fiat, the equivalent. So in fact, they would have to have 2 deposits, the same ones. Exactly. We know that the XRP token as a token has come a long way because there was that fight with the SEC and so on. But among crypto enthusiasts, I clearly emphasize that I'm talking about crypto enthusiasts, not blockchain enthusiasts. A certain faction of XRP token believers has formed. That's a difficult word for me, has emerged. Not Bitcoin, not Ethereum, but it seems to me that this group is no longer as strong as it once was, but at one time it was a very strong faction that claimed XRP is the one, that cryptocurrency in the banking world. The fact that the settlements between banks need to be accelerated. I don't think anyone has any doubts about that. Yes, but why would banks want to buy XRP? I found a great article about Goldman Sachs, which also signed up to test this Ripple. What will happen when XRP costs $100? The answer was simple. After all, it couldn't be used. Because that's all we're testing for now. All banks are in fact only running pilot projects on it. So they are testing. And if this token, meaning we as investors will count on this token increasing in value, then it will lose its sense of use for them. Because those transactions become in effect expensive for them. Yeah.
Exactly. And that also leads me to recall a certain reflection that appeared somewhere, I think, in many heads regarding various projects, because we witnessed something that probably won't return, the great ICOs, the great pumps.
XMP actually had a really huge ICO.
Yes, yes. The market has really taught us a valuable lesson here. At the very least, those mass ICOs, which were undeniably the main star of one particular season, if we treat a season as a full market cycle, meaning a 4-year period, are highly unlikely to ever return in that same form. It might happen incidentally, of course, just like we recently saw with the IPO action. But the era of mass ICOs as we knew it is likely behind us for good.
I truly believe that it still provided a viable solution where we can raise capital from all over the world. And the great thing is that we don't have to limit it to such a narrow scope, which really gives us much more flexibility. But now you really have to have a product, whereas before it was enough to write a beautiful idea on a piece of paper.
Beautiful
Idea.
Exactly like that. I've noticed in general that every cycle has its own star. At other times it was NFT tokens.
Yes.
And so on and so on. But what I'm getting at, returning to that original thought, is that you can have a great project, which in my opinion is the foundation for a token to actually generate value for investors. Two things have to happen there. First of all, it must be tied to a project that makes sense. It makes sense. This project must solve some business need. I am, of course, talking about a situation where this token is meant to generate value not for 1 month, but for years. So it must be tied to a project that generates good solutions, solves a certain business need.
Value.
Yes. But the second thing, which is very important, is that there must be good tokenomics. Because if you only meet one of these conditions, meaning you have a super, let's be honest, if there isn't a good project, there isn't a good technological solution, and we aren't really solving some need, then such a project will live for a month, maybe a year, and that's it. It will be gone.
We can't know its marketing strategy, but
the point is
that
this marketing, because we've talked about this before too, we know that a token can have great marketing, great, and people buy it and they don't even know why they're buying it, and they're pushing through and so on. But at some point, that verification comes. Suddenly, someone asks, you'll get the question, well, okay, but what is the use case for this business?
Exactly, sometimes. And
I'll call
something into question,
because
it's sometimes I feel fake it until you make it. And would Solana, if not for that great marketing, have had so much tokenization? Already abstracting from the fact that it was mainly meme coins. We are coming to the point that it's often old school thinking that the product will defend itself. The product won't defend itself. You can have an inferior solution. You can have the worst solution on the market. You will have great marketing, a lot of capital. You will improve this product, so it will be the best. Google didn't have the best search engine. Yahoo had the opportunity to buy Google several times and always wanted to buy it for a little less money. And today, where is Yahoo? Where is Google? And that's what I'm getting at, that it doesn't matter that your solution is better, faster, because that's also this fight with Bitcoin. Oh, that blockchain transfers faster, cheaper. That's not important. And here I disagree with you a little bit, because I agree with you on that. But sometimes in this world, you have to pump yourself up so much and have such capital here just to then sometimes try to make a very good product.
I understand. I accept that.
Unfortunately, that's how the world looks. It's sad.
However,
that's how it looks. Many car companies created better electric vehicles than Tesla, and yet Tesla is the one dominating.
Yes, well, because you're right. It's not the best technological solutions that win, but they have to represent something with it. They have to. So the composition of something that is, let's say, good, along with marketing and promotion, that's the key. We are nearing the end, so I will just say what I think is the foundation of a good token. It's the connection to a product that delivers value. Some value must be delivered. And the second thing is good tokenomics. If you have a great product, great solutions, but your tokenomics are messed up, the token is either being produced too much or it's too weakly linked. Then the connection to what the project does, the fuel, is too weak.
I understand, but I see that Ethereum changed its tokenomics along the way. It changed those rules because at first there was that pump, but I come to a slightly different conclusion because I also looked at several of these blockchain solutions from big corporations, and some of them use Ethereum solution. JP Morgan practically copied Ethereum. And we come to the point where I sometimes get the impression that we were the sandbox, we were the testing ground, and these institutions were watching and saying, oh, go ahead, have fun, we won't bother you, so that later, after all, this source code is open.
That is correct, right?
Or even to later jump on the creators of Ripple or the creators of Ethereum or many others and say, do this for us, but on our terms.
Sure. And
I have such an amazing conclusion.
I'd like to keep talking about this with you, but I'm looking at a big screen behind the computers. I mean, behind the cameras, which says we have about 3 minutes left.
So actually myths. Have you ever wondered about the world's wealthiest pets? Do you happen to know which cat is currently the richest in the world?
The cat? No.
Tell me, are you familiar with the iconic fashion designer Karl Lagerfeld?
Are you familiar with him?
These.
Yes.
And that cat also appears there very often as a logo. That was his beloved cat. And I didn't know this story, but he left him an inheritance. And of course, there are very big problems because it's French law and you can't leave an inheritance to a cat. But some lawyers thought it through, so they left it to the caretaker, who is to take care of this cat for life. The cat not only appeared on covers by himself, received photos, and was already getting paid during his lifetime, earning money and putting it aside for the cat's foundation, but he also got an inheritance, admittedly only a part of it, because obviously most of it was contested since the law didn't allow it, but it is estimated that over $1.5 million is in the cat's account. And
my fun fact is related to my favorite band from the days when calls were billed by the minute. When I was a kid, I really liked the Guns N' Roses lineup, and when Axl Rose had a falling out with Slash, I couldn't get over it. And apparently someone once asked Axl Rose if there was any chance that Guns N' Roses would play again, but in the lineup they used to have. And Axl said, not in this lifetime. And somehow it turned out that a few years later, he made up with Slash. The band got back together and went on a concert tour, which was called Not in This Lifetime.
Not in This Lifetime.
That's right.
That immediately reminds me of the first James Bond, Sean Connery, who said he would never play James Bond again. And then he came back after George Lazenby, who was an unsuccessful James Bond, and he had said earlier that he would never play it again, and then never say never. Yeah.
Except that was actually just a side Bond.
That
wasn't in the main line anymore, but never say never. He played then.
Very
interesting. Okay, Marcin, thank you very much. As always, interesting research. And you, my dears, we ask for comments, for thumbs up, for subscribing, and write what you think in general. Our discussion today was, as you can see, very extensive and multi-threaded. Thanks. Thanks.
Sławek. Thanks. Take care. Bye.
you